Hello everyone, welcome back to Safe Stock Investments. Emcure Pharma has delivered a strong opening quarter for financial year 27 with revenue growing at 22.8% year over year, while EBITDA increased by 25.8% and adjusted profit expanded by 34%. More importantly, the company exceeded the report's expectations across revenue, EBITDA and PAT, with the performance beating estimates by 6%, 7% and 21% respectively. This indicates that the underlying execution has been stronger than anticipated one. The improvement in EBITDA despite pressure on gross margin is particularly significant because it demonstrates the company's ability to offset an adverse product mix through operating leverage and better cost control. Employee expenses and other expenses declined as a promotion of sales, supporting the improvement in profitability. For investors, the key message is that Emcure's growth is not dependent on single operating factor. Revenue momentum and operating efficiency are working together to strengthen earnings of the company. One of the strongest features of the current performance is the broad-based momentum across Emcure's international businesses. In the first quarter, the ROW segment grew 45%, Europe increased 33%, and Canada expanded 25% year on year. This compares with 10% growth in the India business, showing that international operations are currently growing considerably faster than the domestic market. Europe is benefiting from strong base business executions and increasing contribution from the new launches. Canada is gaining from new product launches, market share gains, and steady growth in the existing portfolio. Meanwhile, the ROW business is being supported by the ARV portfolio as well as healthy momentum in the non-ARV products. The diversification across these markets is strategically important because it reduces dependence on a single geography and provides multiple revenue for the future growth. The domestic business grew at 10.2% year on year in the first quarter, and the quality of this growth is very important. The strong traction in CNS, cardiology and women's health supported by key brands and in licensed portfolio, organic India growth excluding in-licensed products was approximately 6 to 7%, while price increase contributed around 4 to 5% and the new launches contributed another 1 to 2% with a balance coming from volume. Zeventus is also moving from its earlier restructuring phase towards acceleration, which could become an important contributor to domestic growth from second half of financial year 27. The company is additionally focusing on chronic therapies and expansions of Povitstra, while productivity improvements are supporting commercial efficiency. The analyst expects approximately 11% revenue compounded annual growth from the domestic segments over financial year 26 to 28, suggesting that domestic business could increasingly complement the strong international performance of the company. The encouraging aspects of the quarter is the improvement in operating profitability. Gross margins contracted by 340 basis points year on year to 58.4%, reflecting an adverse product mix. However, EBITDA margin still expanded by 50 basis points to 19.7%. This is an important indicator of operating leverage because the company was able to protect and improve EBITDA profitability despite lower gross margins. Analysts expect EBITDA margins to expand by 70 to 100 basis points during financial year 27, while gross margin is expected to remain around 59%. At the same time, research and development investment is guided at 4 to 5% of revenue, with more than 30 to 35% of revenue already generated from products delivered through Emcure's own research and development pipeline. This combination of R&D-led products, operating leverage, and disciplined cost management provide a strong foundation for sustained earnings improvement of the company. The forward earnings trajectory is one of the strongest reasons supporting the buy recommendation. The analyst expects Emcure to deliver approximately 15% revenue of compounded annual growth rate, 21% EBITDA compounded annual growth rate, and 25% PAT compounded annual growth rate over 26 to 28. The expected growth in EBITDA and profit after tax is significantly faster than revenue growth, indicating an important element of operating leverage and margin expansion. The earnings estimate also raised by 7% for financial year 27 and 2% for financial year 28, reflecting stronger expectations for the ROW ARV order book, continued scale up in Europe, and improving domestic formulation growth. Return ratios are also expected to improve, with ROE moving from 20.2% in financial year 26 to 21.8% by financial year 28, while ROCE is projected to rise from 17% to 20% over the same period. At the same time, the net debt to equity is expected to decline from 0.3 times to 0, with management targeting to complete debt repayment by financial year 28. These combinations of earnings growth, improving returns, and declining leverage strengthen the long-term investment case of the company. Putting the complete picture together, Emcure Pharma presents a compelling growth story supported by improving execution, diversified international operations, domestic recovery, expanding margins, and strong earnings visibility. Based on a valuation of 28 times of 12 months forward earnings, the analyst arrived at a target price of Rs 2,300 and reiterates its buy recommendation. For long-term investors, the combination of broad-based growth, improving profitability, stronger return ratios provides a solid fundamental basis for considering Emcure Pharma as a buy. Thank you for listening to this video. Thank you for sparing your valuable time. Happy investing.